If you woke up this morning and saw SpaceX, yes, SpaceX, exploding 19% on its very first day of trading after the biggest IPO in history, and you started thinking, maybe I should just pile into these world-changing tech giants like the AI leaders and SpaceX and ride them straight to effortless wealth? Then, my friend, you might be mixing up two completely different things. On Wall Street, there's a cold, hard truth that few people want to admit. A great company almost never makes a great investment. When you start believing a stock's price is so high it doesn't matter anymore, that's exactly when the bubble begins to bite. Tonight, let's talk about how to stay clear-headed while the party is in full swing. First, we need to understand one really important thing. What actually is a bubble? When people on TV talk about financial bubbles, they love throwing around complicated math formulas and going on about price-to-earnings ratios and valuation models. But honestly, the truth is much simpler and far more human. A bubble isn't really a math problem. It's a deeply distorted state of mind. It's a short-lived collective madness. Wall Street has an old but incredibly accurate saying, the 3 stages of a bull market. The first stage usually happens right after a major crash. Everyone is bleeding. Everyone is terrified. Only a few sharp-eyed people dare to imagine that things might get better someday. The second stage is when the economy actually starts recovering. Companies are making real money. Smart money quietly moves in, and regular people begin to notice that things are genuinely improving. But then comes the third stage. This is the real danger zone. In the third stage, the air is filled with good news, and stock prices are skyrocketing. Then the scariest thing happens. Everyone reaches the same consensus, that things will only keep getting better. Forever. This is the full-blown FOMO stage, that miss out and you're screwed anxiety. You see your neighbor getting rich. You see your friends making easy money. Suddenly, you start hearing the most dangerous phrase in finance. This company is so great, the price doesn't matter anymore. When you literally can't imagine any risk. When you feel like you're the only person on earth who missed the boat. When you're convinced that buying at any price is the right move. That's the sound of the bubble inflating. But wait, I know what you might be thinking. Aura, this time is different. Artificial intelligence is the real deal. It's changing everything. You're right. AI is absolutely real. But let me tell you a harsh truth. Every major bubble in history was built on something real. Just yesterday, SpaceX completed the biggest IPO in history. It opened at $150, surged as high as over 30% during the day, and closed around $161, up roughly 19% on its first day of trading. This made Elon Musk the world's first trillion-dollar man and pushed SpaceX's market cap to over $2.1 trillion. A lot of people are now extremely excited, saying, "The space age is truly here. This time it's really different. The internet was real too. We literally can't live without it today." But in the late 90s, people believed the internet was so revolutionary that the old rules of gravity no longer applied. They blindly chased anything with .com in the name. They didn't care about profits. They ignored history. They kept saying, "This time it's different." And when the bubble burst, those companies lost more than 90% of their value. Let's go further back. In the 1960s, there was a group of stocks called the Nifty 50. They were the best, fastest-growing companies in America. People bought them at insane prices because everyone believed these giants would rule the world forever. If you bought them at the absolute peak, many massively underperformed the market over the long term, and investors who bought at the top lost over 90% at one point. Why? Because in the real world, no tree grows to the sky. Nothing stays on the throne forever. Let's look at some cold, hard data. Think about the top 20 companies in the S&P 500 back in 2000. Fast forward to today. How many of those giants are still in the top 20? Only a handful. And of today's beloved Magnificent Seven, only Microsoft was in that top 20 list 24 years ago. Change is the only constant in the market. Today's disruptors will eventually be disrupted by tomorrow's new technology. Naively believing any company can win forever is extremely dangerous. This leads us to the biggest blind spot for regular investors. We constantly mix up two completely different things. We think a great company automatically equals a great investment. But the oldest truth on Wall Street is this: a good investment isn't about how good the thing you're buying is. It's about the price you pay for it. How amazing a technology is doesn't actually matter that much. What matters is how much you're paying for it. When you buy a stock, you're essentially buying a piece of that company's future profits. Let's talk about this in plain English. The price-to-earnings ratio, or P/E. When people are completely blinded by FOMO, they're willing to pay 30 times, 40 times, even 60 times earnings just to get in the game. Do you know what that really means? It means you're paying up front for the company to deliver 2 or 3 decades of flawless, mistake-free, competition-free perfection. You're assuming it will never face serious rivals, and management will never make even one mistake. You're paying for absolute perfection. And in the real world, perfection doesn't exist. In one of Howard Marks' famous memos, he shared a chart that instantly wakes you up. The data shows that when investors buy the broad market at very high valuations, like the 22 to 26 times we're seeing now, or even higher, their returns over the next 10 years are often very limited, sometimes close to zero. Think about that for a second. You could hold the world's best companies in your hands for a full decade and make almost no money, simply because you paid way too much for your ticket. But here's the most empowering truth about investing. You don't have to play this dangerous game. You don't need to chase the very last dime of this euphoria. If the price feels completely detached from reality, you have every right to simply step back. Stepping back doesn't mean doing nothing or abandoning the market entirely. It means shifting your focus away from chasing the hottest stories and toward building a real sleep well at night asset system. You can hold cash patiently and wait for better prices. You can focus on companies with reasonable valuations, strong moats, and stable cash flows. You can spread your risk instead of putting everything on a few must-win stocks. In short, turn investing from an emotion-driven frenzy into a disciplined, repeatable process that can keep making money even while you sleep. This isn't avoidance, it's true intelligence. Of course, this is just my personal observation and not investment advice. Please make decisions based on your own situation. So, tonight, take a deep breath and relax. Don't let the fear of missing out steal your sleep. Protect your cash and your peace of mind first. Wait patiently for the tide to go out. And when the tide really does recede, we'll talk about how ordinary people like us can gradually build that sleep well at night asset system, the kind that keeps making money even while you're sleeping. That's exactly what we'll break down in the next episode. This is Aura's Midnight Essay. Sweet dreams tonight, and I'll see you soon.